All right. Well, welcome everybody. Thank you for having me on. For those of you that don't know who I am, my name is Steve Bigalow. I happenstanced into candlestick analysis over 30 years ago. And I became very good at it because prior to candlesticks coming along, I was the worst investor in the world. And so when I started looking at candlestick analysis, I kept thinking, this makes sense. And if it makes sense, I should be able to just do everything opposite that I'm normally doing. So I'm going to go through this real quick, just so you can see the indicators that I'll use as far as analyzing any charts that we want to look at today. So I've written 3 books on candlestick analysis. And I've discovered that out of the 50 or 60 candlestick signals in the candlestick universe, you only have to know 12. We call this the 12 major signals. And the reason that occurs is because 99.9% of the time, these are the signals that are going to be showing up, whether you're analyzing the market indexes, commodities, currencies, anything. Candlestick analysis is merely the graphic depiction of everybody buying and selling during a specific time frame. So there's one basic rule for price movements. Prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. So the Japanese rice traders have a very simple philosophy. If you see a candlestick reversal signal in the overbought condition, and I use stochastics of 1233, that the probabilities are pretty strong you're going to be in a downtrend. Also, if you see a candlestick buy signal in the oversold condition, the Japanese rice traders make their philosophy very simple. You're probably going to see an uptrend. Now, on my charts, they're going to be relatively simple because we want to make the emphasis on the signals themselves. You'll see that I have the 50-day simple moving average. There'll be a red line, which is the 200-day simple moving average. And the reason we have those on our charts is because everybody in the world that manages money uses those moving averages to make their decisions about their portfolio. We don't make or have them on our charts to make our decisions. We have them on our charts to see what everybody else's decisions are. And then here's the most important one. This is the T line. The T line is the 8 exponential moving average. It has Fibonacci characteristics. It acts like a natural support and resistance level of human nature. So here's the most comprehensive statement you'll see today, that if the candlestick signals are the graphic depiction of everybody buying and selling during a specific time frame, we're essentially illustrating investor sentiment. And the T line acts like a natural support and resistance level of human nature. When you combine those two, you've got an extremely powerful trend indicator. So very simple T line rule. If you see a candlestick buy signal and a close above the T line, you can stay long until you see a candlestick sell signal and a close back below the T line. Now, why is this important? Well, if you were like me, being one of the worst investors in the world, what is our biggest fear when we've got a profit in a trade? Boy, would I look stupid if I let this profit turn into a loss. So I better take profits, even though there's no reason to take profits. I'm going to take profits. Well, what the T line does is it keeps you from making those emotional decisions and tells you how long to stay in that position. So anytime I see a strong reversal signal, like a best friend signal, which we'll illustrate a few times today, which is a doji gap up. And the reason we call it your best friend, not only does it tell you which direction this price is going to move, but it's going to tell you that it's going to move in that direction with extremely powerful movement. And if it's coming out of the oversold area and closing above the T line, we don't have to do an analysis of this trade. Our analysis is about maybe 3 or 4 seconds every day, that as long as it's not doing a sell signal or close below the T line, you can stay long. So here's a truism. But if you see a candlestick buy signal and a close above the T line, the probabilities are extremely strong that you're going to be in an uptrend. Same scenario on the downside. If you see candlestick sell signals and a close below the T line, you can stay short until you see a candlestick buy signal and a close back up above the T line. So the truism is, if you're in an uptrend and it's staying above the T line, if it closes back below the T line after a sell signal, close it out. That's where there's been a change of investor sentiment. So your strongest signals that we're going to be demonstrating, again, is your best friend signal, which is a doji gap up. We recognize patterns like J-hook patterns. It looks like a J-hook. And this is what creates your strongest trades. Again, no matter whether you're trading currencies, commodities, tulip bulbs, anything that has fear and greed in it. So these patterns, like a J-hook pattern, there's 3 types of J-hook patterns. And we know that on a J-hook pattern, there's your J-hook pattern, that wave 1 and wave 3 are going to be about the same. So if you're an options trader or even a stock trader, that right here you might be buying calls, knowing that if this is going to be moving in the same magnitude as this after a J-hook pattern, well, maybe as it's moving up, you start putting spreads on to enhance that return. So a J-hook pattern uses the T line to give you very effective wave 3 setups. So notice how this one started with your best friend signal. Then your next signal was a kicker signal, which we'll get into. So if we knew this is wave 1 and this was starting wave 3, where do you think the next logical target everybody was watching? Right up here at this level. So I always tell people, don't be afraid to put the T line on your chart. It works very well. I always tell people, the first time I had sex, I was so afraid. But then again, it was dark and I was all by myself. So the J-hook plus is seeing a J-hook pattern that comes up and pulls right back to a support level and then starts wave 3. So you can see the added advantage or the added implication that this was where everybody was starting to buy. So if I see this little J-hook plus, if I know this is wave 1, we've got a pretty good estimate of where the next target's going to be. The bobble breakout is another one where instead of it coming up through, it fails at that resistance level that everybody's watching, and then does a little J-hook pattern that breaks out to the upside. Now, we can see it as a J-hook pattern, and it was supporting at the T line. So why are we buying right here? Because we know the pattern breakout is about to occur. And what do you think everybody and their brother is watching? They're watching to see whether it's going to get through the 50 or not. And when they see it does, they start piling in, and that's what creates the next strong price move. So we're going to be illustrating strong trades from the kicker signal. A kicker signal is where it opens here and closes here, creating that dark candle. The next day, they gap it up above the previous day's open and go the opposite direction, kicking this trend in an uptrend. And here's what is where a candlestick analysis greatly enhances. When you see a breakout, should you be buying here, buying here, buying here? Where should you be buying? Well, remember, candlestick signals are the graphic depiction of everybody buying and selling during a specific time frame. So if you start seeing a best friend breakout, you just flip to your 10-minute chart. You could be buying here, buying here. Maybe you're not buying here, buying here, or buying here, but now you can see they've started back up. You could be buying here through that for the rest of the day. So anyways, this is what we're going to be using as far as analyzing the different stock charts. Now, we're going to be looking at whatever charts you want to look at, and I'll show you some charts that we've been trading that are making a lot of sense. And before I go too far, we have a very high-pressured, high-powered marketing technique. We call it our horseradish technique, which is basically a 2-week free trial on our website. We have a chat room that's open every day or when the market's open. We do training sessions every night, not every night, every Monday night for members. Thursday night, for example, tonight will be an open session for everybody. And then during the week for members, we do special sessions like high probability entry and exit strategies, the common sense application of stop losses, how to scan for the best trades, things that all apply to the common sense elements of candlestick analysis. The reason we call it horseradish marketing is I grew up in Pittsburgh and I never knew what the background of H.J. Heinz was. It was just a big stodgy food company. But when I read the history of H.J. Heinz at the age of 12, back when bottles were green, they would put horseradish in it, which would also include sawdust and all sorts of garbage. Well, he had a high quality product that he would put in clear bottles, and then he would take it around to customers or the grocers and give them a taste test. And once they saw the quality in the bottle and they tasted it, they saw the logic of buying it. And that's exactly what the candlestick analysis is it's merely just common sense put into a graphic depiction. So let me figure out now, let's see, what end of that. All right. So somebody was asking about the cues. So here is again, the benefit of candlestick analysis. Remember, if you see a buy signal close above the T line, you stay long. See it close below the T line, you're in a downtrend. Now look what's happening up here. Over the last few days, in the overbought condition, you started seeing indecisive trading. Now, I think even more concisely on the NASDAQ, same scenario. Look where this topped out, right at the same level it topped out before. And now you had a sell signal, a bearish engulfing signal. And now you're trading back below the T line with stochastics heading down. What is the overall assumption of what's going on in investor sentiment right now? It's bearish. So any long positions, you're probably starting to take profits on and looking at short positions. PAR. This we would put into the classification of being a nothing chart. There's no direction. So and this is kind of where the simplicity of candlestick analysis greatly improves your I guess visual analysis. Which direction is this price going? It's going sideways. So if you look at a chart that really doesn't have any great potential to it, because of the simple scanning techniques for finding the best trades out there on any given day, there's 9,500 trading entities out there. In the matter of less than 10 minutes each day, once you do scans, you're going to find the best trade setups. And so then the process at that point is, if you found if your scans that night found 3, 5, 7, 10, 12, 15 good trade setups, now the process is you go back through and kind of cultivate them to see which one is the best trade. So Pat, I would say that is a nothing chart. I'd be someplace else where you have better prospects. GFI, you can see we recommended the gold stocks a few weeks ago. Notice what was happening down here. You had a double bottom. There's your doji best friend gap up. Now, a lot of people are told if you see gaps, stay away from them. That is goofy. If you see what the signals are telling you and gapping it, it's telling you exactly what's happening after those signals. They're trying to get into this move with great enthusiasm. Now, Here's the common sense elements put into candlestick analysis. The Japanese rice traders make it very simple. Where do you want to be buying? You want to be buying when you see buy signals in the oversold area and they start gapping it up. That tells you they're coming in with great strength. Where do most people buy? They buy exuberantly at the top. So if you're starting to see gapping up in the overbought condition, you start watching to take profits. So you can analyze, I think this is the right chart. You can see where gold started forming a bottom, double bottom, and closing above the T line, and then gapping up through the 50. So if that was telling you that gold was acting well, it doesn't take very much to go back through and say AU could be bought. And again, it's gapped up over the last couple of days, so you'd be ready to take profits. Now, look at the other element where you want to take profits. I should have added this earlier. That again, if you see a candlestick buy signal and a close above the T line, you can stay long until you see a candlestick sell signal and a close back below the T line, with the caveat that the further away you move from the T line, the higher the probability it's going to come back and test it. So this would tell you that if you're gapping up in the overbought area that far away from the T line in the overbought condition, get ready to start taking some profits. Why? Because human nature works the same way time after time. That's probably what you're starting to see, some profit taking starting to occur. How do you decide that the live price, which is currently a double top, will continue up to become a J hook in hindsight? Darren, give me an example of that. But that is what you can determine is, trying to think of one, that if the price comes up to the previous high, remember, each candlestick signal, 12 major signals, if you start to see sell signals like a doji or a shooting star, things that show indecision at those levels, that's giving you a good indication that's going to be a double top versus breaking out into a new high territory. So once it gets to that resistance level, you just watch to see whether it breaks through or whether it is giving you sell signals. Zeus, this is what we call a bearish J hook pattern. Notice your downtrend. They tried to bring it back up. There was your bearish Harami. Now, I also have the 34 EMA on my charts because the main criteria on a candlestick chart are the signals themselves. Everything else is just a confirming indicator. If somebody says, put the XYZ indicator on your chart, and you do, and it doesn't do you any good, take it back off, because the main consideration is my buy signals and my sell signals. Everything else becomes a confirming indicator. I tell people, this is not rocket science. These are patterns that are illustrated from what the Japanese rice traders have identified over 400 years of analysis. The Japanese rice traders did not become wealthy trading off of candlesticks. They became legendarily wealthy. They were the financial powerhouse in Japan for centuries, and they did it off the most boringest commodity in the world, rice. So I would be looking at, what do we just look at here? Oh, Zeus, ZS. Here's your bearish J hook pattern. What's that imply? Wave 1, wave 2, wave 3 should be the same magnitude as wave 1. Wes, getting a little bit toppy. Notice how you're starting to see sell signals up here. You're in the overbought area. This candle right here is called a dark cloud, because the Japanese rice traders up, everything's sunny, everything. Whoops, there's your dark cloud. Dark cloud opens above the previous day's trading. not just the candle or the body, but the trading, and closes more than halfway down this candle. This is your bearish harami. In Western terminology, that's known as an inside day. So this is telling me if I was long, if it starts trading lower, especially back below the 50 and or the T line, close it out. That's where they started to fail. Tesla, here's another easy observation. If you're in an uptrend in the overbought area and you have a big bullish candle, let me make this bigger. If the sellers have enough strength to gap it down and close back below the previous day's open, close out the position. The bears have taken control. Right now, you can stay short because that selling started. And notice what else we could see was happening. There was kind of a resistance level right here. Now, what is the trend of Tesla? Pretty much have a wedge formation in progress. The T line is the 8 exponential moving average. Yes, acts like a Fibonacci characteristic, a natural support and resistance level of human nature. Fling. This one is rolling over also. There was your bearish harami. You're back below the T line. I would be ready to go short on this. Maybe not today because it's right here in this support area. If it opens lower on Monday, yeah, it tells me wave 1, wave 2, going into wave 3. So we recommended a few shorts today because the market looked like it was getting toppy. This is called a bearish belt hold signal. Notice how they gapped it way up out of the trading range and came back into the trading range. Kind of a little double top. So what's that pattern tell us? Wave 1, wave 2. Now you can be shorting this, or looks indecisive right now. So you might be shorting this if it starts trading lower. Once again, where would I start thinking about trading this if it trades lower? Well, that's where I flip to my 10-minute chart and say, well, wouldn't be shorting it right now. Looks like there's some buying. But if the 10-minute chart started rolling over, what's that telling me about my daily chart? It's moving in the direction that we expect it to be moving. Twillo was another one. Wave 1, wave 2. Look at your bearish harami right there. Again, an inside day where it opens below the previous day's close and closes above the previous day's open. Now, this is what we call kind of a doji sandwich. Big red candle, a doji, and there's, just like the T-line rule, there's the doji rule. And the doji rule is the price will usually move in the direction of how they open after a doji. So when it opened lower, I told you could start shorting immediately. Now you're looking at this level to see if it's going to break through. When it does, what's our next assumption? Again, wave 1, wave 2. Now you're in wave 3 to the downside. So the reason that the signals make very compelling indicators is because the Japanese rice traders have seen hundreds of thousands of signals. Let me show you an example of the difference between a signal and a non-signal. Right here, when the Dow was bottoming, you could see what happened right here. That was a bullish day. However, it is not a candlestick reversal signal. So what's the implication of that? Well, the Japanese rice traders have spent hundreds and hundreds of years, probably looking at thousands, if not millions of situations like that, that if this was a relevant reversal signal, the Japanese rice traders would have told us what it was, and explain what the investor sentiment was that caused it. Well, there is no signal. So what was the implication? Well, you might have a bounce, but it's not a reversal. Look what happened over here. This is a candlestick reversal signal. This is your bullish engulfing signal, more defined as a left-right combo because it occurred right after a doji. That was a signal, and that was what told you that the investor sentiment had changed. So this is what makes the analysis of what is going on in investor sentiment much more clear just by putting some simple parameters. If you watch to see where you are as far as the trend, you're in the overbought area. And now they're starting to sell off. Notice what happened right here. When they sold off in the oversold area, they did a morning star signal, one of your reversal signals. Where was the next likely target? See what they were going to do with the 50. When they got to the 50, they did an evening star signal, which is a big green candle. And that day of indecision, right at the 50, told you, look out for your doji rule. If it opens lower and starts trading lower, it's going to trade lower. So what did that tell you about the 50? They weren't going up to the 50 or through the 50. They just bounced up there and were heading down. Now, this is what we call, my late friend Dave Elliott of Wall Street Teachers kind of named as a blue ice failure. Somebody's fallen through the ice. What do? They come up and they try to find the hole they fell through. If they can't find it, they drown. Where do they go? To the bottom of the pond. So that is a very high probability trade pattern. Now, I would always help them when we were on tour around the nation years ago, so people would remember the blue ice failure. I always say, how do you catch a polar bear? Well, you cut a big hole in the ice, and then you take a can of peas and you spread it around the edge of the hole. So when the polar bear comes down to take a pea, you kick him in the ice hole. Now, obviously, it wasn't a very technical explanation, but people remembered the blue ice failure. Tesla, you could go short on this one. Now, what you want to watch out for, though, is what type of movement are you seeing? Well, there's kind of that wedge formation. And it could probably even come from down here. So here's the logic. Again, if you've seen selling and a close below the T line, your stochastics are still heading down. That's a good indication you're still probably heading lower. Let me see if I've got. So again, there's only 12 major signals you need to learn. Oh, pshaw, get rid of that. Trying to think back. Darn. It's a morning star signal followed by a doji sandwich. I can't find it right now. All right, so again, if you can identify which sectors are picking up strength, for example, you could see how gold was starting up, making your gold stocks attractive. So this is just common sense, putting stars in alignment. That if you can see the market is heading up, and then you can identify which sectors are the strongest, then you can go to the stocks in that sector and see which ones of those are going to be acting the strongest. Did you mention what time frame you start your charting on? Well, I start with a daily. It depends on what type of trader you are. I used to trade the E-minis off the 1 minute, 5 minute, the 1 minute, 3 minute, 10 minute combination. during the day where I don't have as much time to trade because we've got the chat room open all the time, I might trade soybeans or let's see, lean hogs. You can see that you'd be shorting lean hogs until your morning star signal. Take profits. You can see how it failed at the T line, and now there was your next wave to the downside. So I might be trading hogs off my 10-minute chart. If I was trading it today, look at your big bullish engulfing. Where would you take profits? Right about in here. So one of the things that we teach people as far as day trading is if this is your initial big price move during the day, once you see the sellers come in or where you've reached equilibrium, it goes flat for the rest of the day. That means you can go off and do something else. Now, would I be buying hogs today? There might be a bounce. But right now, I probably wouldn't be trading hogs until it breaks up through this level. Until it does, you have to assume you're in a sideways mode. So if you're a day trader, you can use a combination that works well for you. It might be a 5-minute, 10-minute, 15-minute combination. If you're a swing trader like myself, where my trades are lasting anywhere from 2 to 10 trading days, I'm using the daily charts. If you're a long-term investor, you might be using a daily chart, weekly chart, monthly chart combination. So the patterns work on anything that has fear and greed in it. Doesn't matter whether you're trading stocks, commodities, currencies, tulip bulbs, anything. Let's see, get rid of that. So you can see on Apple where the bottoming action occurred. You had bullish doji sandwich, and then you had your J-hook pattern. So what is the criteria now? Well, notice that they haven't been able to close this below the T line. So you assume you're still in an uptrend until you see a sell signal. Amazon. You're trading back below the T line. After a bearish engulfing signal, stochastic's heading down, you assume you probably don't want to be in Amazon right now. So J-hooks are pullbacks, yes. J-hooks are kind of your wave 1, wave 2, wave 3. Let me MPLEX. Right now, after your big bullish engulfing signal and a close above the T line, all you can do right now is just stay long as long as you don't see a sell signal and a close back below the T line. Now, what's your obvious watching point? Right here. If they come up to this level and you start seeing sell signals, tells you, yeah, they're not going through, take out or close your trade. What's the worst case scenario? They come up, sell off. You can always buy it back if it does a J-hook type pattern back up through that level. So there are a lot of charts. Look at Intel. We recommended Intel because there's your J-hook bobble breakout. Why is that relevant? Because everybody and their brother is watching to see what would happen at the 200. Notice how it did a little hammer signal, which is one of the 12 major signals, gap up, and came up through that level. What'd that tell us? Wave 1, wave 2, now we're in wave 3. And how long would you hold on to this? As long as you don't see a sell signal and a close back below the T line. Now, the nice thing about candlestick analysis is it's telling you exactly what's going on right now. So even if you've got a trading technique that works, just change your charts over to candlesticks overlay them onto the on your charts, and you're going to see the price patterns much more clearly. IMMR, that one I would be out of, because where do most people buy? They buy exuberantly at the top. That exuberance can be in a big move or a gap up in the overbought area. The next day they did a bearish harami, doji type day. Now, what was our doji type rule? It needed to open positive and trade positive. The fact that it opened lower and traded lower, where do you think your next target was going to be? Back down here to the T line. So you would have been out of this trade either here or here, and you wouldn't be back in it until you see a buy signal. Where did this one fail? Right smack dab at a level everybody else is watching, NIE. Yeah, so your bobble breakout potential is, if it curls back up and comes back up through this level, what's everybody watching? They're waiting to see whether it's going to go through this level. If it does, what can we assume? Well, if this is wave one, it comes up through this level, where do you think wave three is going to be? Probably up to this target. Now, does that mean it's going to get there? The probabilities are pretty good that it could get there. But what's our main criteria for a reversal signal? If it came up here and saw a bearish engulfing signal and stochastics rolling over, that's telling us, well, they're not going up. There's some selling. So J-hooks or pullbacks, yes. So remember, I'm getting off track here. No, I don't use Elliott wave. Now, the Elliott wave, I use waves because that's what Elliott wave reconfirmed, is that investor sentiment moves in waves. Remember, the Japanese rice traders already revealed that point hundreds of years ago, that prices move in waves. So as a matter of fact, I will be, the CMT is their 50th anniversary. The CMT is the Market Technicians Association that was established by Ralph Alcapora in New York City. And so I'm one of the guest speakers there at this event, along with Bob Prechter. So Bob Prechter and I have known each other for years. He was the expert in Elliott wave. But Elliott wave does not have let's see, should put it this way. You had wave price move 1, 2, 3, 4, 5 with a ABC pullback. But he even said, and it wasn't Elliott, I forget what his name was, said, it's not concise. You could have a wave 1, 2, 3, 4, 5, 6, 7 with an ABC DE pullback, or but what it did illustrate is that prices do move in waves. The S&P 500, you can see where it was running into trouble. There was your your bullish engulfing signal, right about the same level it topped out before. And notice where it's moved to today. Well, not quite. We kind of figured today would be kind of a consolidation day because of going into the 3-day weekend. But so here's the analysis. Which way are the overall markets moving? Doesn't take a lot of analysis. It takes about 10 seconds to say, well, looks like the Dow is trying to pull back a little bit, and the NASDAQ has pulled back to where it failed at this level and trading below the T line right now. So there's consolidation going on. Would I be a buyer today? No. The gray line is the 34 EMA. Again, whatever you put on your chart, the main criteria is the candlestick signals. Everything else works as a confirming indicator. Got the 34 EMA because it works reasonably well. Some people say, well, why didn't you put the 20 on? 20 works reasonably well. but the 34 seems to work better. But notice where human nature works the same way time after time. This was the NASDAQ. Buy signals, close above the T line. Where was it time to take profits? When they gapped it up here in the overbought area, what was it telling us? Look how far away we are from the T line. What happened the next day? They gapped it down, tried to take it up and sold it off. Where do you think the next target was going to at least be? Back here to the T line. AVAV, this is your best friend signal. Look at your doji, kind of a wedge breakout, a gap up. And what does that tell you? That tells you there's a dramatic new strong investor sentiment. What is our expectation after a best friend signal? This is what you call a 45-degree. You can stay long as long as you don't see a sell signal and a close back below the T line. We also have the 3T line on here, which is a 3 exponential moving average, which works more effectively when you're that far away from the T line. Now you can use the 3T line to tell you when things are starting to turn over with a little bit more speed. Riot, you can see what's happening here. You're in a slow uptrend after this breakout. Look at your Morningstar signal, gap up through this resistance level. So right now, if you like it, you can stay long as it doesn't close back below the T line. So this is what we do in our training. We're trying to show people what to do. Not just, I put out 2 or 3 stock picks every evening in our members area, not so people have stock picks, but they can see what the rationale was for why it was being recommended. And again, it goes back to the same old theory that if you tell people to do something and they don't understand why, they're not learning anything. What we try to do is teach people how to fish. I kind of put it in the same equation of the cop standing on the street corner, and he sees this drunk weaving down the street. He blows his whistle, pulls the guy over, walks up to his car, and he looks in the back seat, and there's a penguin sitting there. And he goes, "What the heck are you doing with a penguin in your back seat?" He goes, "Oh, I found him out on the street, and I don't know what to do with him." The cop said, "Well, take him to the zoo." Drunk said, "Oh, I didn't think of that." Well, the next day, the cop's standing on the street corner, sees this drunk weaving down the street, blows his whistle, pulls the guy over, and walks up to the car, and the penguin's sitting in the back seat. He goes, "I thought I told you to take the penguin to the zoo." And the drunk said, "I did. He liked it so much. Today we're going to a baseball game." So if you don't understand what these signals and patterns are telling you, they don't do you much good. But we know what the results are of specific price moves. Once we see a best friend signal, we know we have more upside until we see a sell signal. So here's another best friend signal that we recommended the other day. Here's your best friend breakout through this level. This usually has strong follow through. Now, one of the worst investment strategies that I hear people say when we say, "Well, you want to be buying this one on strength." I have so many people say, "Well, I'm going to wait for it to pull back so I can get in at a better price," which is a very stupid trading strategy. If you see a bullish reversal, what do you want to see? You want to see strength. You don't want to see it pulling back. And 2, what are you expecting? You're expecting your immaculate entry, that if it's pulling back, that as soon as you decide to buy it, it's going to turn around and go right back up. That's very wishful thinking. What we're looking at is, if we see the signal, we know what the expected result is. We want to be buying immediately. Can you consider a close below the T line a sell signal, or do we have to wait to close below the T line? You can use that if you've moved too far away from the T line, now you can start using the 3T line as a quicker criteria. But that quicker criteria might be that you're seeing a sell signal and a close below the 3T line. You might start taking profits with the idea that it's going to come back and test the T line. That's right, stupid pullback. So if the two advantage, or a major advantage, is not only does candlestick signals tell you where there's new bullish sentiment, we recommended Newmont Mining after it came up through this level, because where did you think the next target was going to be? They were going to come up here and fill this gap. It's still not selling off, even though it's down a little bit today. But notice the nature of this signal. It's very indecisive. Tells us there's not a major change of investor sentiment. So what would be our next expectation? Well, if this is wave one, wave three should probably come back up and at least test this area. Now, once it gets to that area, we're a little bit more diligent to see whether there's buy signals or sell signals at that level. EPD, look at your big bullish left-right combo. We call this a left-right combo because it was a bullish engulfing signal after a doji. Anytime you see a combination signal with a doji involved, it's usually going to be that much more compelling. So we have a system or a quantitative list of the strongest candlestick reversal signals. There's about 15 of them. But number one doesn't mean it's good and number 15 bad. They're all good. So we just try to teach people how to recognize which signals or patterns are the strongest, so that even if you don't want to try to learn all 15 of them, you pick out 3 or 4 and become very adept at those. So there's your left-right combo. What is this chart telling us? There's no selling going on. You stay long until you see a sell signal. So it doesn't matter what you're trading. Look at NVIDIA. Could pretty much stay long as it stayed up above the T line. But now, what is the warning? Well, they gapped down below the T line. If this doesn't come back up above the T line, start selling off, it's telling you you've had that change of investor sentiment or that change of probabilities, that if you're now trading below the T line, close it out and wait for the next buy signal. Now, for long-term investors that may want to hold on to something like this for long-term, and you're not going to sell it, at least it gives you the opportunity to say, well, maybe I start writing some calls against this position until I see it curl back up. So I always remind people, I'm going to go to crude oil. Whoops, CLAK23. You can see what crude oil has been doing. When it started down here and started turning around, you also saw reversal signals occurring in ExxonMobil or Apache. So if, again, this is just putting the stars in alignment. If you can see the commodity that a sector is working off of, you can see the market is moving in a new direction. You can then go see which stocks in that sector are producing the best trade setups. So ExxonMobil we just did. Right now, there's nothing telling you. I mean, it might be getting a little bit toppy up in this area, but there's nothing yet that's telling you there's a sell signal being confirmed. So I always remind people, you don't have to overanalyze candlestick charts because there's a lot of information built into the signals and the patterns. It's kind of like the lady that brings her parakeet into the vet and lays it down on the table and says, "Oh, can you help my parakeet? He's been my best friend for years and something's wrong." And the vet says, "Well, ma'am, I think your parakeet's dead." She goes, "Oh no, he's been my best friend. Can't you, isn't there something that you can do?" And he goes, "All right." So he goes to the back of his clinic and comes back in with a cat, lays the cat next to the parakeet on the table. The cat sniffs the bird, looks up at the vet and shakes his head and goes, "Ma'am, I'm sorry, your parakeet's dead." She goes, "Oh no, he's been my best friend. Are you sure? Isn't there something just to make sure?" And he goes, "All right." So he goes out to the back of his clinic again, comes in with a great big Labrador retriever. Labrador retriever comes bounding in, puts its paws up on the table, sniffs the bird, looks up at the vet, shakes his head and goes, "Ma'am, I'm sorry, your parakeet's dead." She goes, "Oh." So they go out to the front desk and he goes, "All right, well, that'll be $250. She goes, "You're charging me $250 to tell me my parakeet's dead?" He goes, "No, ma'am, I would have done that for $18. Then he wanted a CAT scan and a lab report after that. So you don't have to overanalyze candlestick analysis. It's all common sense put into a graphic depiction. So David, did you get the link for the 2-week free trial?
I don't think I got a link.
Yeah, Abraham was supposed to send it to you.
Let me check.
Or easier
No.
way. All right. If you would like to do a 2-week free trial, I mean, there's no pressure. Our marketing is very high pressure. If after 2 weeks you don't see what the common sense is of candlestick analysis, it's probably not going to hit you. But again, when I started out, I was the worst investor in the world. I was even a stockbroker with Kidder, Peabody, Cowan and Company, and Oppenheimer. And I got out of the business because I realized that the analysts at brokerage firms had no more idea about what made prices move up or down than the man in the moon. And then when I started looking at candlestick analysis, the first thing that whacked me in the side of the head was, this makes sense. And the more I looked at it, the more sense it made. So anyways, that's about all I got. Is there anything else that I can answer for people? I'm going to so if I'm trading cattle, you could start buying here. Look at your doji sandwich. Now, the implication of a doji sandwich is that there's going to be more upside. So what would we be doing on a long position of live cattle? We'd be staying long, but now you've got a gap up in the overbought area. So we put a safety stop right here because logic says if it comes back down through the low of today, where are they coming to? They're probably coming back to test the T-line. So every time I put on a trade, crude oil sitting right here. I think it's actually in about the $81 range. You're in the overbought area. What should this price be doing? Well, right now we don't have a sell signal. So where would be the logical place to put a sell stop? Right here. Because if you had a doji, hanging man, and then selling off, it tells you this is the area where they're starting to take profits. Let's take our profits and close out the trade. Merck. Right now, you stay long. There's your doji sandwich. And notice what the doji sandwich did. If we know that this candle right here and this candle right here is going to be about the same, what'd that tell us about this breakout area? They were going through it, which tells you this resistance area isn't there anymore. You stay long until you see a sell signal. Let's see. Oh, it's up. So I would probably put a safety stop right about the 3T line, because if it came back down through there, what that tells us about the breakout area? They aren't breaking out. So here is another example that if you see a big breakout situation and you've got some big profits, where do you know to take profits? You go to your 10-minute chart, say, whoops, they took it up and it was a big whipsaw. I better flip to my 5-minute chart, say, whoops, I better start taking some profits right in here, because where do you think they're going to come back to? Back to the T line. The moving averages on these charts are the 200-day simple moving average, which is, whoops, where is it? This is the red line. The blue line is the 50-day simple moving average. Again, these are the moving averages that everybody in the world uses to make their decisions about their portfolio. We don't use them to make our decisions. We're using them to see what everybody else's decisions are at those levels. The black line is the T line. You could take everything else off the chart, use your stochastics and your T line and the candlestick signals, and you're going to make very good high probability trade setups. Again, anything else you put on this on a chart is just going to enhance or add to the probabilities of being in the right trade at the right time. Which one did I just do? Oracle, but that's the 10-minute chart. Oracle. Ever since your doji sandwich, more upside. There's kind of your J-hook plus. What do you do with this one? You just stay long until you see a confirmed sell signal. Volume I've already eliminated as a criteria. My trading universe is stocks trading greater than 5, because I want to be able to margin stocks, because I know every time I put on a trade, I've got probabilities going in my favor, so I want to get as much leverage as possible. And stocks that are trading more than 200,000 shares a day. So a lot of people say, well, I want to see the volume going up when the stock price goes up. Volume and price have absolutely nothing to do with each other. If nobody wants to sell stock, and a stock that's going up, it's going to go up on lower volume. Now, if you do happen to see a big volume day on a day like this, that's a pretty good indication that the weak have sold into the strong. And that's where I learned how to use candlesticks, because I was always selling down here. And I would say to myself, how come every time I sell, it immediately turns around and goes up? Or every time, how come when I'm buying up here, as soon as I buy, it turns the other way? What I discovered was the Japanese rice traders have illustrated where the reversals have occurred, and that puts you in a position where you're now trading with the smart money instead of the panic buyers or the exuberant, or the panic sellers, exuberant buyers. What is stock on the bottom of chart setup? What are stochastics? 1233. And that was a very sophisticated analysis. So somewhere around 30 years ago, I was sitting in my living room at my desk saying, all right, if candlestick logic works, I should be seeing buy signals. So what are the stochastics? At that time, it was 1455, but I'm a swing trader. I wanted something a little bit faster. All I did was tweak for about 20 minutes saying, well, let's try 1432 or 1351. And I came up with 1233, where it seems to correlate pretty much with the bottom and the tops. GE, nothing wildly exciting. If I was long, it would still have to stay pretty close to the T line or close above the T line. Would you go long on Oracle? No. Where should you have gone long on Oracle? And this is the question I always get asked in our training rooms. Where are you now? You're up in the overbought area. It's already had a huge move. What is the trading strategy here? FOMO, I guess that fear of missing out.